Equities have given high returns, but this is always on a long term.
60-40 is a fair asset allocation because if equity markets fall further by 25%, your debt will earn you so much money. If you analyze the behavior of markets, markets give you mediocre return, then comes one good year, takes the return up. Then you have 3 years of lull, again a very good year, it pulls up the return. Objectives can remain more constant. Views change every 3 months. So attach yourself to an objective is what treasuries do. Trader needs to know कल क्या होगा. उनको direction की पकड़ होनी चाहिए. Investor को trend की पकड़. I met a gentleman, he says, my entire portfolio is doing very well. If all your portfolio is doing well together, it can also do disastrous together.
Investment can never be done through noise. You have to filter the noise and then you have to have a mechanism that you believe is best for you.
Fixed deposits don't have uncertainty. They don't create the wealth they should. They safeguard your wealth, get you some nominal return. Uncertainty is something which you have to embrace. You draw your balance sheet, it has to be across advisors, it has to be across assets, it has to be every rupee which you are not using only is meant for growth. Minimum return in the last 20 years of 4 general elections, 1 year investment is minimum is 70, maximum is 55. मेरी बैलेंस शीट में अगर 5 करोड़ रुपया आज है तो उसका टारगेट 10 साल में 20 करोड़ का होना चाहिए. 15% से अगर ऐसे को ग्रो कर पाओगे तो वो 5 करोड़ 20 करोड़ ऑटोमेटिकली हो जाता. कंपनी को उधार दो तो उसको कहते हैं डेट. उनको जाके पैसे देके उनके पार्टनर बन गए तो उसको कहते हैं इक्विटी. There is one instrument called a leap. It is nothing but a portfolio insurance. If you have bought the leap on NSE, NSE gives you a compensation for the fall.
Hello and welcome to Business Television India. I'm Abhishek Ranjan and you're watching The Financial Planner. Over the past 1 year, we've brought you some of the finest trends and analysis dominating Indian markets, helping you make the right investment choice. As we kick off the new series of The Financial Planner, the focus continues to remain you and your financial freedom. From stock markets to mutual funds, inheritance money to creating a will, from gold to real estate, and from investing for your retirement to investing for now. We packed it all and will continue to bring this and much more in the episodes ahead. BTVI's financial planner Feroze Azeez is a deputy CEO of Anand Rathi Wealth Management and has over a decade's experience in the capital market segment. He's known for his radical methods of wealth creation and financial engineering. On this episode of the Financial Planner, we'll talk about the mega financial distress that has hit the Indian economy. In what began as a singular event, with IL&FS defaulting on its dues, snowballed into a liquidity crisis for many NBFCs since October 2018. DHFL, IL&FS and SL Group crisis not only show poor corporate governance, but also that the debt funds too are ridden with risks. Many of the funds had to mark down scheme of their schemes portfolios, impacting the NAVs negatively. In the same context, to help us defog the concept of markdown of papers and how it impacts investors in turn, we bring in Feroze Azeez. A very warm welcome to the show, Feroze. Always a pleasure to have you with us. Help us explain, what does markdown of papers mean?
Markdown of papers, which has been spoken about of late very frequently, is nothing but a phenomena when any of the bonds a debt fund holds goes below the investment grade, which is triple B, BBB. If it goes below that grade, the asset management company and the fund manager are duty bound to mark the value to the markdown value in the NAV. So if there is any fund which actually slips below triple B, you have to get the valuation done, and the valuation of the paper, which will depend on several criteria, will be taken for the NAV computation, which implies that the NAV of the fund due to this markdown will go down, and the extent of it going down will be dependent on two factors. Factor one is the extent of the problem, in terms of if there is a bond which is 10% of the fund or 9% of the fund and that gets marked down, the dip in the NAV will be larger. And the second is, what is the rating agency's fair value estimate? So asset management companies don't value it, the rating agencies value it, the asset management companies use it for the NAV computation. This phenomena of bringing down the value of the bond which has gone below the investment grade in the NAV computation is called the markdown phenomena, Abhishek.
What next once the AMC marks down the value of a paper?
Correct. So what happens is, then the normal course proceeds. For example, if there is a bond which has been marked down below BBB, at maturity, if the bond didn't default and the entire payment was paid by the issuer, then the markdown gets reverses itself and you get back the value where it was marked down from. For example, if there is a fund holding 100 crores of a specific issuer which has been downgraded from whatever level to below BBB, the value of that 100 crores in the NAV computation, let's assume, has fallen to 50 crores. The NAV is now being computed assuming that the fund or the issuer's bonds value is just 50 crores. At maturity, if the issuer pays back the 100 crores, the 50 crore additional gets added back to the NAV at maturity of the bond, if the default or the bond which got downgraded didn't actually default. In case at the end the bond actually became a default bond and didn't pay up the 100 crores at all and paid only zero, then the proceedings of recovery the asset management company goes through, and that money, whatever money comes, 10, 20, 40 crores or even 70 crores, gets added back to the NAV as and when it actually comes in.
And Feroze, as you just explained, NAV does take a hit, in fact gets impacted negatively. But the moot question here is, what happens with the remaining markdown assets? Will that remain with the mutual fund? And whenever the recovery happens, will the investor get the money back? In fact, to give you a quick context where this is coming from, in fact, only last month, you had the likes of HDFC Mutual Fund and Kotak Mutual Fund rolling over their FMPs maturing in April 2019 for another 380 days.
See, Abhishek, what happens is, there are several examples which have unearthed themselves with this default and the debt market liquidity crisis, especially on the NBFC side. Now, when it comes to the specific examples of Kotak and HDFC FMPs, fixed maturity plans getting rolled over, first it's important to understand that fixed maturity plans are nothing but debt funds which are closed-ended in nature. The investors come at the same time and leave the fund at the same time, and the fund perishes or doesn't exist anymore and closes itself. That's why it's called a closed-ended fund. In an FMP, since the bonds which were bought are being held and some of the bonds require more time to be liquidated and the monies have not slipped in, that's why these two asset management companies chose to roll it over in the interest of the investor, of course, because they don't want it to be, don't want those bonds to be sold at junk prices in the marketplace. So point one, a key learning from the illustration which you exhibited, Abhishek, is to say, make sure that you don't buy fixed maturity plans because your hands are tied. And even if there's a bond which defaults in an FMP, you don't have a recourse of an exit, unlike an open-ended scheme. So that's one thing which we can surely learn from this episode, and say that in spite of you wanting to put in corporate debt funds, but you have to choose open-ended schemes so that you have the possibility of liquidity in case of any crisis, and you're not bound by the fine print and extensions become a mandate on you.
In the context of fixed maturity plans, as we just referred to as FMPs, which again falls under the closed-ended funds category, portfolios are not disclosed, thereby again bringing into light the risk of getting into something that you don't really know, you're not aware of. How does one understand the problem and get in?
See, Abhishek, I think that that's not a big problem. Because when you take an open-ended fund, any investor who's buying an open-ended fund is not going through the actual holdings. You ask even a sophisticated HNI or even a ultra HNI individual saying that if you have bought a Franklin Templeton dynamic accrual fund, what are the top 5 holdings? Has he seen them? The answer is a big no. I think people just go with this guiding principle. If the rating is good, the fund is good, which I think has been challenged, and I have been propagating not using ratings for the last 6-7 years, because that's not the only measure you can use to evaluate credit risk. You're duty bound to make sure that you use other risk measures. On the same show, I've told that people should use something called the Altman Z score to evaluate the credit worthiness of a company and not just go by an external party as a standalone mechanism of credit risk. To answer your question, Abhishek, even if I buy an FMP and if I trust the fund manager, I would go with it. Of course, the portfolio is not created yet, but on the other hand, on the portfolios which are created, I don't think investors are even bothered to look at the top 5 holdings and do some analysis, and they just go at ratings which are there, and FMPs generally indicate the rating to the purchaser, if not the specific bonds.
Well, Feroze, you raised a very pertinent point around the role of credit rating agencies. We'll come back to that in a bit, but again, talking of open-ended funds on the other hand, wherein you have the option of getting to know the exposure. The level of disclosure itself, again, is a separate topic of discussion. But how does one assess the credit risk, and how should one select a credit risk fund?
See, I think, yes. So when it comes to FMPs and open-ended funds, FMPs initially don't have a disclosure, but after 15 days of the FMP getting listed, every bit is actually something which is an open book for as much as an open-ended scheme. So it's just the initial phase where you will have to rely on the fund manager's judgment of having done 500, 200 FMPs in the past and buy an FMP. Coming back to the very valid question, what do we do when you're buying a credit risk fund or even a bond fund or a basket of bond funds? Firstly, diversification is a very, very important tool in the debt market. It is more important. Diversification is first point I'm making, Abhishek, and the second claim I'm making, or the first claim I'm making, is in debt, diversification is more important than in equity. Why so? Because in equity, even if the markets fall, they come back and recover with time. But in the debt market, if there is a casualty or an accident on the way, that does not repair itself with time so easily. If a company has gone bankrupt, and if it does not have a recovery rate, even if you gave it 100 years, that money isn't coming back. But in the market, which is the equity market, a recovery is bound to happen. It's only a matter of time, 1 year, 2 year, or even 10 years, but it's certain that the markets will come back to where they started falling from. So point one, make sure that there is enough diversification in your debt portfolio. Point two, when it comes to diversification, you should at least have a debt fund portfolio with minimum 200 issuers, not just bonds. 200 issuers have to be in your portfolio in the form of 4, 5, 7 mutual funds. You should go into it or ask your advisor to unwrap those 6, 7 mutual funds and tell you how many bonds are there in the portfolio. That's rule number 2. Rule number 3 is not just rely on credit ratings. For the top 10 holdings of your bond portfolio, you should find out something called the Z score, which is a far, far better mechanism to predict credit rate defaults. And in the last 20 defaults in the country, Altman Z score has done a wonderful job in predicting 14, 15 of them 2 years before they actually went default. So that's the third point I'll make. And if you're able to take care of these 3 things diligently on a continuous basis, I don't think you'll have to ever be worried and panic in situations like these where there are compressed number of defaults happening in a short span of 6-8 months.
Well, with that, we slip into a very short break. We'll continue the conversation with Feroze once we are back from a very short break. Feroze, it would be great to understand, in fact, you did bring out during the course of this discussion the role of credit rating agencies. Now, it'll be better to understand from you to get a clear, a better understanding onto how things have changed on ground. Now, if you could share with us your understanding of how the role of credit rating agencies have changed. Now, we are talking about the two phases here. One, before the crisis that we just talked about at length unfolded, and now, that is post the crisis.
See, Abhishek, I think unfortunately or fortunately, rating agencies didn't do a very good job because even a AAA rated company overnight going down to default is not something which an investor is mentally prepared for. And not just the ILFS episode was very much on the in the face kind of an episode, but in the past also a large number of defaults have happened on papers which were AAA or even AA just a couple of years before they went default, or even 1.5 years before they went default. An analysis threw up that rating agencies have been more reactive than proactive. Now that's point one. That's the matter of the past. I think this can actually have a larger implication in the future, because now, after so much of criticism on rating agencies will move from one end of the spectrum to another and start downgrading several of the already existing bonds, which will create more panic than some degree of calmness, which is what a debt market needs. So I sincerely hope that rating agencies don't move from one end of the spectrum and move to the other, and just to save themselves from any criticism in the future, start downgrading bonds more differently than in the past. When it comes to new bond issuances, new issuers ratings, they can be a little more vigilant, but changing ratings of several issuers could actually create a huge panic, just because rating agencies are now going to be far more on the edge. So that's one fear on the debt market, and if that continues to happen, then people's faith on the entire ecosystem of lending can be shaken up, and that can create a lot of liquidity crisis and run for the money on several issuers and impact their businesses, which is not actually required at this point in time.
Debt, again, as you keep talking, Feroze, in fact, debt, according to you, is an integral part of the portfolio. Now, if you could help us narrow down on 4 to 5 such debt instruments that one must consider when investing, when contemplating investing into a potential debt instrument.
I think from an Indian context perspective, we are in a high interest rate economy. Unlike Japan or the US, we are relatively significantly higher on interest rates. So debt becomes an integral part of the portfolio because it brings stability and still gives you reasonably good quality return, which is, at least on the CPI, beating inflation. See, if CPI is your measure of inflation, is beating inflation. So point one I'm making is debt is an integral part of investing life for the next 5, 7, 10 years. So you can't live without it. Point two, that brings us to what are the actual available products which I have, and which ones are the safer ones, and what should be my strategy and allocation across these different product classes on the debt side. Of course, if I mention a few, PPF, EPF is one, which is debt, which is tax efficient as well. Then you have fixed deposits, then you have corporate fixed deposits, then you have mutual funds. You definitely have debt in the form of NPS, and you have mutual funds. You have two categories. One are the high credit risk funds, the other ones are the bank PSU funds, which are two important categories. So you have basically 5 product classes, important ones. In the mutual fund category, you have 2 subclasses. So this becomes the universe of debt investing, and it's important for you to have a strategy in place so that you're not worried when these kind of episodes happen, Abhishek.
Lastly, Feroze, now that you've narrowed down the list for us, what would be your recommendations from the list of debt instruments you just highlighted?
See, the top recommendation will be PPF and EPF. Because they come with huge amount of tax efficiency, and they have a very low credit risk because they're government backed. That's the topmost. The second one is, to my mind, a bank fixed deposit. from a credit risk perspective, from a default perspective, bank fixed deposits, because banks have a larger role to play in the system and they have been regulated in a very, very tight fashion. NBFC's regulations are 1/3, if I just put a number to it, with vis-a-vis RBI's regulation on banks. So I would say first comes EPF, PPF, the second is bank fixed deposit, the third is mutual fund, because mutual funds can give you a very diversified platform of investing. The fourth is tax-free bonds, and fifth is corporate fixed deposits. If you look at the advantages and disadvantages of each of them, PPF has an interest rate which is tax-free and has a reasonable higher interest than the 10-year government paper. So on PPF and EPF, tax efficiency very good, return great, risk very low. So that's why it's on the top. If you went to bank fixed deposits, their risk is low in terms of default. Second, interest rates, return mediocre, little on the lower side. Tax efficiency very inefficient. Mutual funds very diversified, so brings down the risk because of diversification. Returns very good, tax efficiency wonderful because it gets you indexation and long-term capital gains. Tax-free bonds lower on interest rate, have very good tax efficiency because they're tax-free, as the name suggests. They're also PSU backed, an infrastructure company backed, so they're low on credit risk. And corporate fixed deposit becomes the riskiest one with a higher interest rate, bad efficiency on the tax side, and a very high credit risk.
With that, it's a wrap on this edition of the Financial Planner. More news and updates continue on the other side. Keep watching Business Television India.